you get somebody who comes to you talking to you about the thing that they've been thinking about since they were 16, 15 years old.
Yeah.
They're so excited about it. And the opportunity to make that real for them in some way.
Welcome to The Alternative Investor, the definitive show for investors seeking private alternative investments. Here's your host, Matt Johns.
Today I had a great conversation with Zak Slayback, a partner at the 1517 Fund, a venture capital fund that backs college dropouts working on hard problems and sci-fi scientists at the earliest stages of their companies. Since starting in 2015, they've raised over $175 million, which they've deployed to over 150 early-stage companies. They regularly lead deals at the pre-seed and seed stages. They focus on tech, including software, hardware, and deep tech verticals. They also provide a community to hackers, makers, and scientists from across the world. Now, Zak is a fascinating guy in his own right. He's authored multiple books, most recently with McGraw-Hill, and he engages regular discussion through his Substack, which you can find at zakslayback.substack.com. Our discussion dives into the ethos of the 1517 Fund and Zak's personal experience. He was generously open with his thoughts and had some great suggestions for investors. Welcome to my conversation with Zak Slayback. Now that the seasons are changing, are you into any kind of sports or anything like that?
I've got a young family. So whatever keeps my 2-year-old entertained right now. I mean, my work requires a lot of travel. So when I'm not traveling, I really am trying to stay close to home. We're in Western Pennsylvania, so it's very much like a fall, pumpkin patch, corn maze kind of season for us. So
yeah, you kind of get the Storyland feel there.
Yeah, right.
Zak, thanks again for being here with me today, joining me today. And tell me a little bit about what you're doing at the 1517 Fund. I think it's a fascinating fund. You guys are on Fund 3 right now. But I want to start out with a question, because you guys have invested in over 100 companies at this point. And to get to that point, you have to have invested, or you have to have had conversations with at least 1,000, if not multiple thousands of different managers and startup founders. So of those interactions, what was an interaction with any founder that really stood out to you, something that was memorable?
A lot of them are memorable in the sense that by the time somebody gets to us, either through referral or they write in, we have a very goofy, very specific thesis. So our general rule is if somebody is connected to us and they fit that thesis, somebody on our team will at least try to talk to them, whether we think they're actually a good fit for our investment or not. And then we can kind of make that decision from there. But by the nature of what early stage venture is you are looking for top quartile, top decile, top percentile companies and individuals. So everyone kind of sticks out in a way or another. It's actually more remarkable when you talk to someone who is like completely and totally unremarkable in our space. The founder that one of the founders I work closely with, who I recently actually just saw for an update at his laboratory, and that we've got to know fairly well over the last couple of years, is a young man who was connected to us through a friend of mine, actually, and has been working on gene therapies to cure certain chronic diseases. And this is a young man. He dropped out of the University of Wisconsin-Madison, was working on this in his parents' basement. So almost to the stereotype, working on a deep tech problem that was traditionally very capital intensive, but for a number of reasons over the last decade or so has become significantly less capital intensive, at least at the earliest R&D stages, and made significant headway. And he was making claims that we've now funded a handful of experiments that lend credibility to the claims he was making. But he was making claims that he was able to cure chronic diseases that nobody had been able to make significant headway on in 20, 30, 40 years. And when somebody like that reaches out, the question we always kind of have to ask ourselves is, is this person crazy or are they crazy awesome? And it's not always obvious. And in his case in particular, it was really not obvious which one he was before we were talking to him. He'd renamed himself after like a fictional character. And again, he was asking for millions of dollars to do experiments that nobody on planet Earth would have normally given this person at this stage. And we had to make the decision as a team whether or not to do a little bit of an investment there. Tell him like, hey, what can you do something like $50,000? My colleague Michael recounts this story in his book, Paper Bout on Fire. This was right around the time that I was joining the investment team. So I was in on the meeting, but ultimately this fell on the feet of the general partners to make this decision. And the question that was brought up was, well, if 1517 doesn't give this person money, probably at this stage, nobody will. And if he lights our money on fire, that's normal. At that point, it's $50,000 of a $24 million fund.
But the upside had to be huge for something like that.
And if he succeeds, the upside is so, I mean, financially, the upside is absolutely significant, but also just the upside from an impact and story perspective is just absolutely huge. So
that's interesting.
He is the person that comes to my mind when I think about why does the fund exist? What do we try to back? It is that profile of person, somebody who, if they were talking to a traditional VC who probably made their money, say in the early 2000s, the dot-com bubble, probably has certain criteria that they look for that I would describe as, from a risk tolerance perspective, a little bit more conservative, a little bit more traditional. You particularly do see this in biotech and therapeutics in particular. Those investors tend to follow a very specific model that is that our model would be very contrary to. So for us to be able to support that kind of founder is absolutely what we exist as an organization to do.
That's interesting. And have you followed up with him? Do you have any updates on where he is now since the end of Fund 1?
Yeah, I mean so he was actually Fund 2 investment initially. So it was right at the beginning, I think, of our Fund 2, maybe a year or so into that. And he's made really, really good progress. I can't talk about the specific details of it, but he's made really great progress. We've been excited to back him repeatedly with a number of relatively large investments for us. So we went from what was relatively small to putting in some of our largest positions that we've ever taken in a company to support that founder. But that's the kind of profile we like to find. Another example would be my colleague Michael gave a grant to a young man that we met through. We were at an event for a Great Books program, and he was on a panel on higher education, and he and I were chatting in the library of this campus later that day. And a young man whose brother I'd previously met at through another acquaintance comes up to talk to us. And this young man's at Harvard. I think he's a junior, maybe senior at the time. He was a junior. And he's talking to us a little bit about the people that he knows. He says, hey, I've got a buddy who's building hydrogen guns in his garage, I think for the Navy. He's 18 years old. He's a high schooler down in San Antonio. Would you guys want to talk to him? Maybe that's something that, because we have a small $1,000 grant program too. Maybe that's something your $1,000 grant would be interesting for. And we're like, yeah. Like the classic kind of profile of what we look for is somebody who, they were for fun, like building rockets or bombs or something in high school. And that's a common theme between both of those two founders I've just told that story about. And that founder, he ended up matriculating at MIT in the fall. We gave him an angel investment to do a little bit of R&D on the work that he was working on. He's since gone on to start one of like the main up and coming defense technology companies.
My word. How awesome is that? So you got to tell me a little bit more about the 1517 fund, its genesis. Then even prior to your arrival in the fund, why was it started? What's interesting to me too is you focus on your tagline, college dropouts, then in the same breath, scientists, right?
Yeah.
So from people who are perceived to have less education, which we know the reality there, and then scientists who are perceived to have the highest level of education. Sure. So I'd love to hear more about the thesis and where that's coming from.
Our fund's co-founders, my colleagues Michael and Danielle, our general partners, they're also the co-founders of something called the Teal Fellowship. So in, say, 2011 or so, thereabouts, the PayPal co-founder Peter Thiel announced that he was starting a grant program, an anti-Rhodes scholarship of sorts, to pay brilliant young people $100,000 to drop out of school, take time off from school, and work on technology companies. It was, pilloried at the time, right? Like Larry Summers, who was, I think, the president of Harvard at the time, who goes on to join the federal government later on, calls it some of the most misguided philanthropy of the decade. Just totally drug through the mud. And if you look 10 years on now, a little bit more than 10 years, I think, at this point, from the initial classes, it's had the highest hit rate of any program in Silicon Valley of giving money to outstanding founders. And the idea was to find these people way before they wanted to be founders. And they were just working on technology. The way my colleague Michael tells the story is he was hired at Peter's hedge fund. And on the first day, he gets pulled into a meeting and told, we're starting an anti-Rhodes scholarship. We want you to help run it. So that goes on to become the Teal Fellowship. It was originally called the 20 Under 20 Fellowship in some cases. 20 people under the age of 20, $100,000 every year. Every year they would announce new classes, $50,000 over 2 years for the grant. And after a handful of years of doing that, my colleague Danielle joined Michael shortly thereafter when they were starting it. And after a handful of years of running the program, they were looking at the early success stories that were coming out of it. People who had gone on to start companies that now those who are up to speed on pre-IPO and IPO stage technology companies would recognize. Companies like Figma. The founder there, Dylan Field, was a Teal Fellow. Ethereum, even though it's not a company, the project was founded by Vitalik Buterin, who was an early Teal Fellow.
Oh, I didn't know that.
Yeah. Initially, the way I've heard the story told is that Vitalik was originally actually wanting to work on something more in like the ed tech vertical, the education technology vertical. But they wanted to stay on top of him as a person, because he was clearly very brilliant. He had taught himself Mandarin, had taught himself a number of things that were very, very difficult for somebody to pick up from an autodidactive perspective. So Vitalik Buterin, Ritesh Agarwal, who's the founder of OYO, Laura Deming, who's gone on to found a number of companies in the longevity space. So a number of companies at this point that if the fellowship had actually been an investment rather than a grant, the fund that was doing those investments would really do quite well. In addition to that, a lot of the types of people who, even if they got a fellowship or they became a Teal Fellowship finalist, still had a hard time being taken seriously by traditional Sand Hill Road, Silicon Valley venture capitalists. A lot of venture capitalists like to talk about, particularly nowadays, they like to talk about something like being contrarian and looking for these criteria that would be outside the norm. Right?
Yes.
But ultimately, at the end of the day, the companies that can raise money most easily, that have the highest valuation caps, that are the best capitalized, tend to fall into like very specific patterns that are highly credentialized, and they're highly path dependent. So Michael and Danielle founded 1517 in 2015. I met them previously when they were still running the Teal Fellowship, and I ended up joining the team in 2017 towards the very end of Fund 1. So our thesis is to back founders who don't have undergraduate degrees. That means they either didn't go to college, they dropped out of college, they're still in school maybe, and deep tech scientists. And when it comes to deep tech scientists, our definition of deep tech is almost sci-fi, right? Sometimes people write in and they'll say, well, I'm working on this advanced software technology, and it's fairly rare that we consider software to be deep tech. There are some exceptions to that rule, but it's typically a hard tech thesis. So for example, we're fairly we were fairly early investors in a company called Atom Computing, which is a neutral atom quantum computing platform. They recently announced a partnership with Microsoft. Or Lambda, which is a cloud GPU platform. A number of other companies that might fall in this more deep tech, hard tech part of the thesis. Ultimately, the founders we get most excited about working with are those who are simultaneously non-credentialed and working in deep tech. So the young man I mentioned who is working on gene therapy would be a great example of that. We are investors in a company that has built radioisotope batteries for a number of industrial and non-industrial government applications. And that team was a team that found us out of Vanderbilt And one of the founders there went on to become a Teal Fellow. So again, working in something that's traditionally considered either very deep hard tech or deep tech in general, and not also non-credentialed. So we invest anywhere from $50,000 at the R&D stage. So gene therapy guy, radioisotope battery guys, good examples of that. The defense company I mentioned, also a good example of that. Up to $1 million at the seed stage as entry checks. So somebody might have already started their company. Maybe we got to know them over the past year. Maybe there was something we weren't comfortable with, whether it's the market they were in or we didn't know them super well at the time. So we decided to hold on that angel stage or that pre-seed stage. Maybe we'll write $1 million check at their seed stage, though. And then we'll typically have a handful of companies that are outperformers. And we'll follow on into those through the life cycle of the company, through whether it's through our main fund or it's through special purpose vehicles that we're able to create for our LPs.
You do follow-up investments with the successful companies.
We will, yeah.
Okay.
So those would typically be in a different vehicle, for a portfolio theory reason. But if a company we think is a real outlier company, we've got significant allocation in the company, and the company needs the extra capital typically. So those also tend to be, that ties into the allocation question. So they do tend to be harder tech companies. Occasionally we do get a software company that we're able to support that way. But ultimately we have to thread this needle of providing that opportunity to our LPs who might have their own portfolio approaches or their own allocation targets, while also hitting the portfolio theory that we want in our main fund.
Now, when you came in toward the end of Fund 1, correct? So at that point, you were brought in for a very specific reason. What was the mutual match where you were interested in them, they were interested in you? Obviously, you'd had conversations beforehand. What's your role now?
So I had approached, like I said, I'd met our general partners when they were still the directors of the Teal Fellowship at the Teal Foundation. And then I approached them after I left my previous company, and I kind of half jokingly told them, look, I studied philosophy. I think I've got like decent verbal intelligence, but as far as like hard skills in tech goes, I can know my way around like a very basic code base. But outside of that, I think my main skill at this point in my life is I can hustle. I'm pretty diligent in following up with people and trying to make informative judgments about those individuals, especially if I'm like trained by somebody else to do that. I would love to work with you guys in some capacity, right? And they told me, okay, interesting. Well, we're going to be raising a new fund soon. In the meantime, you're a prolific writer. Why don't you help us with some of our marketing content? Help us get a blog up and running, a podcast, things like that. And so that's what I did. And initially at first. So I was actually working more on the marketing side of the team. And then when our second fund was put together, they gave me the opportunity to come and work on the investment team initially as a principal. Because at that point I'd started finding people, sending them to the GPs. So the gene therapy guy is a good example of that. And they allowed me to try my hand on the investment committee. So in our third fund, I came up to partner. We're at the end of that third fund right now, at least the initial deployment phase of that third fund. And we'll be starting our fourth fund relatively soon.
Oh, congrats. That's great.
Thank you.
So you mentioned tech, though, and how that wasn't your area of competency when you came into it. How are you? Because you still, even in your role now, you still have to maintain a deep understanding of technology, even to communicate it, let alone to be able to make these investments. How do you guys stay on top of everything and understand it to such depth that you can recognize what's going to be a positive trend, negative trend, what's really something genuinely unique that's being put before you?
Yeah, I mean, I'd say there's probably two answers to that question. The first is a bit of a reframe. That is, it's pretty rare the technology doesn't work. It tends more to be the people don't work. So, a pre-seed fund, a seed fund is like a 10-year fund and can typically be extended once or twice, depending on what the LPA of the fund says. It's kind of hard to say exactly what is going to be like the moneymaker in 8 to 10 years. you can get a sense of it, right? If you understand like certain macro trends. So like I can give you a theory on why I think there's going to be a big uptick in the types of founders we work with. I mean, we've already seen this in the last 2 years. The types of founders we work with being interested in like biotech and why you didn't have that previously. Like there are macro reasons for certain trends, but ultimately at the end of the day, it's pretty rare the technology just completely fails. It's more the teams fail. So we're really indexing heavily on founder traits. And we are typically investing in teams. A handful of the founders I've mentioned are solo founders, but they're also the founders I would say are working in harder tech areas and are what I would just simply say brilliant, right? So there's that. And then the second thing is, I mean, we wouldn't describe ourselves necessarily as a generalist fund. There are specific verticals we like to invest in more than others. But yeah, my background is philosophy. My colleague Michael, his background's philosophy. My colleague Danielle, I think she majored in music and founded a charter school previously. Our whole team, colleague Nick didn't even step foot on a university campus as a student. Very non-traditional backgrounds.
That's fascinating.
I mean, we've extended that. As a team has grown, everyone on the team has a fairly non-traditional background for VC.
But what's interesting about that is that you guys don't come in with a technical background, so therefore you don't have that mindset that you have to have technology in the brain all the time to be successful. You realize that this diversity of thinking, the ability to think, is more powerful than what you know.
Yeah. I mean, I can give you an example for a Fund 1 company that has become like a fairly well-known company at this point. Is the company started as a consumer mobile app that did have some technical element to it, some neural net technical element to it. But ultimately what ended up happening was the combination of the costs to run neural nets back then. This would have been probably 2018 or so, 2017, 2018. This was probably 2017. The cost of running those kinds of neural nets, combined with the fact that a competitor came out from left field and just undercut them and cut the floor out from under them, meant that they had to pivot. And they were able to pivot to a totally different vertical, which in this case was hardware. And then from hardware, they were able to make their way into cloud computing. And now that company is worth over $1 billion, when at the time previously it looked like it was actually going to go under because of the combination of the costs of what they were doing and being undercut by some of their competitors. But if you're indexing on the market or you're indexing on the technology, you might either miss out on that, or you might write it off way too early. Where if you're indexing on the founders, and that's fundamentally the model that I've learned from my GPs, our GPs have learned from Peter Thiel, to be indexing very heavily on the founders. They have to be working in a venture scalable area, right? A venture-backed company has to get so big within a certain amount of time. So there are like necessary but not sufficient conditions that I would consider important here. But we are fundamentally looking at founder traits. Now, particularly if we're working with companies in deep tech, we do need to do some kind of technical diligence on them. And the main way we do that is we have a network of advisors who are experts in specific fields that we'll pull on. If we have a company that is, say, working in material sciences, we'll hit up somebody in our network who we know is a material sciences expert, have them talk with the founder. And what we're looking for in that conversation is that they can talk as near peers, and that expert can come back and say, yeah, they're going to run into XYZ problems, but it's got legs to it. We don't want them to say like, oh yeah, it's obviously amazing and it's going to work, because then there's probably some question of like, well, why hasn't it been done yet that we're missing?
Yes.
But we also don't want them to say like, oh, they're totally missing like these two big things that they haven't even thought about at all. We expect there to be objections, but they should be an objection of a certain type where you understand the right kind of person can figure that out in time. So my colleague Danielle likes to say the job is really advanced tutoring, reverse advanced tutoring. We get paid to learn from people who are a lot smarter than us, whether those are the advisors we work with or the founders. I mean, you get somebody who comes to you and they are talking to you about the thing that they've been thinking about since they were 16, 15 years old.
Yes.
And they're so excited about it. And the opportunity to, hopefully make that real for them in some way.
Oh, that's such an interesting perspective. And that leads right into what I wanted to ask you next is how do you support these different founders and that you're bringing into the fold? And you've got the grant program too, which I'd love to hear more about how that leads into the fund itself. But obviously there's a support nature too, based on you guys and your expertise, your LPs and other folks that are kind of playing into this. And that, other founders networking with each other. I'd love to hear more about that.
Like you said, Matt, we have done well over 100 investments at this point over the 3 funds we've had, but we talk to thousands of people a year, right? We've run the math previously. We probably should run it again relatively soon. That we probably end up investing in about like maybe 1 to 2% of people we talk to.
Mm-hmm.
And so everyone we talk to, we can't invest in, whether it's because we don't think they're ready for it. They're not working on something that's venture scalable. There are certain things we prefer not to invest in for one reason or another.
Mm-hmm.
But we might want to support the founder in some other kind of way. So we do have a grant program, and the ideal grantee is somebody who's very early stage and they need $1,000 in cash to help them get over some kind of milestone. Typically, but again, it's going to be a hard tech thing because we want them to go like buy equipment for a prototype. We don't want to go into like general expenses. We'll often give these out if we visit university campuses. So for example, myself and 2 colleagues, we went to go visit the University of Michigan in Ann Arbor last week, and we gave out 1 grant while we were on campus there. So talking to a student wants to build a prototype for something, we can give them $1,000. It's actually a check, but it's essentially a cash grant, no strings attached. We just ask them, keep us updated about it.
No strings attached. So that means they use this. Maybe they give you some credit along the way. Is there anything written in like that, or literally no strings attached?
No strings attached. I mean, we ask them to keep us updated. That's about it.
But you're building a relationship.
Yeah, and we believe that if whether the thing they're working on now or the thing they work on down the line is the thing that they should be pitching us on, that most people will try to remember those who previously helped them.
Of course.
That way. Yeah, it's so funny. We'll sometimes talk to. This is because these kinds of grants are becoming a little bit more common in tech. Almost always domestically here in the States, and we'll occasionally talk to either investors or people in a little bit less forward thinking in terms of how to deploy capital areas. So like Europe, for example, and they'll ask us like, oh, so you make them sign a contract, right? And it's like, no, there's no contract. It's like, yeah, but they have to agree to certain terms, right? And it's like, no, it's cash to build a prototype. In our first fund, like a quarter of our companies were companies that started as grantees, and we can do about 100 of those grants a year. I think it might even be more now. So we're pretty, I think, generous with them. Like I said, it needs to be enough money that it gets somebody over a milestone, and it's not general expenses. And ideally, it's something that we could see ourselves investing in down the line. So if they're working on something that we know there's no way that we're going to invest in, we'll try to provide some other kind of support to them because, again, they might change and work on something else. So we have a community, both remote and in person. The remote one lives online largely through a fairly active Discord channel. And then in person, we try to do things like socials. We do a big 1517 summit every year. This year is in Toronto. The previous year is down at the Kennedy Space Center. Next year will probably be in San Francisco again. We're bringing about 250 to 300 of our community members from all over the world, bringing some speakers. We bring in some of those founders we mentioned, right? So
when you say community members, who is that?
The community members are like the young people, usually young people. But they're the people we might meet on campus, those who write into us, those who are referred to us, whether they're portfolio company founders we do end up backing or those we meet that we don't back because either they're too early, they're currently students. Maybe, again, what they're working on isn't something that we would necessarily invest in, but we have this living community that we try to involve people in. And we might know somebody in the community for 5-10 years before we actually make an investment. I mean, we've had a number of recent investments where either our team met them very early on in the fund or they actually came over from the Teal Fellowship days. That's been, really, really fun to watch people evolve over time.
You develop a lot of relationships with people with a lot of different ideas, and that intellectual property is incredibly valuable. Now, you have some that are very successful, but the majority of your companies that you're investing in are not going to make it all the way to an exit, it be a private equity or even, especially an IPO. So, with those companies that you have a vested ownership interest in, are you doing anything with that IP? Are you negotiating with them and bringing it into? This is a question of personal curiosity for me, but
Mhm.
is there any crossover for IP for these companies, either the successful or unsuccessful ones, or anything in there, or even the grantees?
Not really. I mean, sometimes you might see a very early stage R&D stage company or grantee that decides to close up shop, and they might get acqui-hired by another portfolio company. We will try to help that facilitate that. Less so to try to maximize our returns, because that feels like kind of like picking up pennies from the street for us, and more to be able to support those founders, whether they're existing portfolio company founders or the ones that are shutting down, in their next stage, right? So
Mm-hmm.
we will sometimes see that where, let's say, somebody is working on R&D in, say, like microfluidics, and they decide they have to shut down their company for one reason or another. We might set them up with another company in the portfolio that works heavily in microfluidics, either as just an outright hire or what we'd call an acqui-hire, right, where they also acquire the IP.
Yes.
Um,
I've never heard that before, but I like that.
Yeah. I mean, a lot of the time when you see news that companies have been acquired, particularly if they're not telling you how much the company's been acquired for, it's usually something what we call an acqui-hire, where the investors probably are not getting much in terms of cash back. And quite frankly, a lot of the founding team probably aren't, but the team has somewhere nice to land. They might be getting some stock in the new company, but there's no big cash payout, right? You know, one of the things we do tell founders from an IP perspective is, we told a team yesterday that we were onboarding that was asking about, hey, when should we be filing for patents, like actual patents rather than provisional patents? One of the phrases we like to tell them is that you're not rich enough for justice. The reality is, if you are working on something that is a trade secret and somebody really truly wanted to steal it and then try to crush you on it, a bigger company, they will do that. So you will probably, and you will waste all your time and money in court trying to fight them. And there's very little chance you will probably win in court, particularly at the stage we're talking about, right? We're talking about pre-seed, seed. The lifeblood of a company is its speed, its ability to move quickly. The lifeblood of a startup in particular, it's its ability to move quickly, to get momentum. And if you are bogged down fighting former employees, co-founders, vendors over IP in court, I mean, at that point, the company probably should be written off. So we tell founders, like, look, if you're really actually concerned about this, and there are certain verticals where you do need to be concerned about intellectual property. I think they're fewer and far between than most founders think. You got to keep it a trade secret, right? You have to understand who you're talking to, the level of detail that you're going into, how much you're sharing that detail, and with whom, until you are rich enough for some kind of justice, right? And that's typically later than people think. So yeah, I mean, IP really, at our stage, what IP does is it provides legibility. It's something, it makes it a little bit easier for you to do certain kinds of partnerships. It provides some legibility even on the team, right? Particularly if somebody had developed the technology previously in a different place and they had some kind of claim to it that might be a little bit different than what the company's claim might be. But again, the reality is, like, if Google is kind of the classic example, even Google doesn't really innovate. So, but it is the example people tend to give, is like, if Google wanted to steal your idea, they probably could. Now, the reality is, I don't think I've ever seen, in the 7 years working this fund, the 5 or so years working on the investment team, I don't think I've ever seen a bigger company actually outright steal a startup's idea that I've worked with. I think on maybe one occasion, I came across a venture investor, so a VC, mining a company for information that they then took back to a competitive portfolio company. One or two occasions I've seen that. But it's very, very rare. So again, sometimes we'll talk to founders and they'll request that we sign a non-disclosure agreement before they'll talk to us about how their technology works, and that's usually a non-starter for us because it's like, look,
why bother?
Yeah, why bother? And two, like, if I wanted to steal an idea and go off and build a company on that idea, I would have done that, right?
Right.
I don't do that because that's not what I want to do.
So I do want to switch gears now and talk about the investor side of things. So people who are, because you have LPs and they're typically more institutional investors, I'm guessing, for the fund, but there are probably some accredited investors and other folks, high net worth individuals who are investors in the fund or certainly in other venture capital funds. So what would you recommend for anybody who's interested in investing in venture capital in a fund?
So you're primarily going to be working with high net worth individuals. There's a certain level of capital committed in a fund where it makes sense to start talking to larger institutions, whether those are more established family offices or multifamily offices, endowments, foundations. A much larger fund, you might be talking to like a sovereign wealth fund, right?
Right.
But for most pre-seed funds and most seed funds that were started in like the last decade or so, you're probably primarily working with some blend of like high net worth individuals and ultra high net worth individuals. So that provides, they tend to have a bunch of different portfolio theories and approaches themselves. Sometimes it's almost like fun money, right? And sometimes they're very sophisticated and they have a specific allocation target that they want to have in their portfolio to venture capital. Whereas like with foundations or more institutional investors like endowments, they tend to have like a very specific approach for here's the minimum check we write into a fund. We want to be no larger than 10% of the fund, 25% of the fund. And we expect to get capital back in a certain window. So it really does depend. Now, whether it's people that I've talked to as our own investors or prospective investors over the last couple of years, or friends I've talked to who have thought about raising funds or have invested in funds, I guess the main thing I would say is just like try to understand how early stage VC works as an asset class, particularly the fund you're working with. But also understand that it's an illiquid, risky asset class that has a fairly long return window. Now, so you should not expect capital back in like 2 to 3 years, right? You should be expecting capital back closer in like 7 to 10 years. You might get capital back sooner if the fund either made a later stage investment in a company that's tracking very, very well that might be outside of like the pre-seed profile, or occasionally there are the companies that they can just exit in like 5 or 7 years. That's pretty rare nowadays. Like you can find stories about that like 25 years ago, for a number of like macro reasons, I think regulatory reasons as well. Companies stay private longer, right? And again, it depends on the theory of the general partnership as well. So some funds are much more comfortable selling their early stage equity at a later stage into secondary markets, whereas others might want to hold on until the company is acquired or goes public, right? So try to understand the actual approach of the general partnership and what you can expect there. Also understand that, particularly if you're working with a seed fund or a pre-seed fund, I would probably say the dominant portfolio theory today is this approach that is identified with Peter Thiel. He talks about it in his book 0 to 1, for example, and that would be a power law approach to a portfolio. Where if you're looking at a portfolio of say 40 companies, it's not going to follow a Pareto distribution where 20% get you 80% of the returns. It's actually going to follow more like a power distribution where one of those companies is probably going to earn you all the money from that fund. And the reason for that is simply that early stage venture investing is extraordinarily difficult. So you shouldn't expect, if you're looking at 40 if you're looking at say a fund 2, and let's say the fund 1 is still illiquid, the DPI is negligible, the distributions from the fund are negligible, you shouldn't necessarily expect in that portfolio of 40 like 8 great companies. Depending on the year of the fund, you're probably going to be expecting like 2 to 4. And you would want to have some kind of believable theory for how one of those 2 to 4 is actually going to exit and provide you liquidity. The other thing I'd say is be cognizant. I mean, some of the basic alternative investing stuff, like be very cognizant of fees. People will stack fees on top of fees on top of fees. I know people who will run SPVs to invest in an SPV for like a Series D company. And that might actually make financial sense depending on, again, the portfolio that somebody is looking at overall. But oftentimes what you're seeing there is like the initial SPV is taking some kind of management fee and carry. And then the SPV that's investing in the SPV is taking some kind of management fee and carry. So the actual money that you end up seeing as an LP participating in that second layer SPV is going to be something like 40%, 50% of the money that you would actually expect to see if you'd actually directly invest in the company. Again, that can make sense if you can't actually get access to that company.
That's right.
And you want to have access to that company, and it makes sense for your portfolio, but just be aware of that. The other thing is, what is your broader approach? Some people, they invest in venture just as part of their alternative asset allocation. That might be like 10% of their overall portfolio, maybe 20% if they really like alternatives. And that's of the total alternative portfolio, the total portfolio, the alternative slice of it, 10, 20%. But some people, maybe they made their money either in angel investing or they made it in tech. They like doing direct investments. Some funds do provide you the opportunity either to do direct investment or to do investment into SPVs, into follow-ons. So just understand too, what are your opportunities as an LP to work with that portfolio if you want them. We really do try to provide opportunities for our LPs, particularly our anchor LPs, to either directly invest in companies that are later stage where either we don't have enough allocation or we know that LP can really help that company. Or some of our LPs really, really do like the SPV opportunity where it provides them an ability to double down on a real stellar kind of company, provide a little bit more liquidity, right? So generally, I'd say like just really try to understand how it fits with what their portfolio approach is, how it fits with your portfolio, and try to understand their thesis too, right? The reality is I have no idea how anybody would be like just a generic pre-seed or seed investor. I would drive me absolutely insane. Like you have to have some kind of thesis.
Deal flow alone would be crazy, right?
I mean, it would be absolutely. I mean, I don't know how you'd get the allocation of those companies, but let's say you're just really awesome at it. Like typically, those people, if they exist, they're either high profile or medium high profile people, typically in the Bay Area or in New York, right? Their personalities, right? They are a personal brand. But I also just don't know how you would like diligence those companies.
No way.
Because you just have so many on your plate. So, what is the thesis? And is it a founder thesis or is it a vertical thesis? We have a very goofy thesis. I admit that. And I think the thesis makes sense if you look at like what venture is as an asset class. You are truly looking for like outstanding outliers. A disproportionate number of outlier founders over the last 30 years have been founders who are uncredentialed in some way or another. And if you're trying to capture a slice of those true outlier founders, that would actually be a pretty decent thesis to do. Now, if you're looking at like average good companies, right, which is kind of a strange phrase to use, but like let's say you've got a distribution of good returns, right? And you're looking at the average there, like, you're going to want to go with probably a fairly credentialed founder who I think is like 43 and a half when they started their first company or something like that. But that's not what you're looking for as a pre-seed investor. You're looking for somebody who's way far on that tail. And if you want somebody who's way far on the right side of the tail, you're going to be needing to look for outlier criteria. So if I were a prospective LP, I'd ask, okay, well, what's your thesis? Where did you get that thesis? What's your track record? How are you going to continue to get deal flow? Like, quite frankly, our approach, a large part of it is, I mean, we have a fairly strong brand at this point. If you're a dropout or you're thinking about dropping out or you didn't go to university, we're like one of maybe 3 funds somebody would tell you about, right? We're probably the first of those 3. Now it's taken about 9 years to build that brand, right?
Mm-hmm.
Plus however many years of the Teal Fellowship previously for Michael and Danielle. But you need to have that thesis, some way of getting that deal flow, and like, do you actually work? Like, I'm not at all inclined to like blow our own horn, at least my own horn. But I have had a few weird interactions over the past couple of years where I'll either take a call with the founder at like 3 p.m. on a Friday, and they'll say something like, "Oh, wow, thank you for taking a call on a Friday afternoon." It's like, yes, like, I am working.
Are other people not working? Is that, yeah?
Yeah. I mean, do people just take 4-day work weeks? Maybe. Or like we'll talk to prospective investors, and we'll tell them stories like the ones I've told you earlier, where, we meet this young man in this library of this great books campus, and they look at us and they're like, "Wait, you're actually out like meeting people on the road?" It's like, yeah, that's when you're doing at least pre-seed investing, those people are not currently like working in an office in San Francisco.
Mm-hmm.
Or, they're usually not already visiting funds on Sand Hill Road. They're usually still working in their mom's basement or their dad's garage.
Mm-hmm.
And you have to go if you can't find them, because you can't just go walk into people's basements, you at least have to find the people who know them. So yeah, what's the fund's thesis? How do they actually get deal flow? Do they actually work? Obviously, and then all the usual questions you'd expect, like what's their track record? How much allocation are they trying to get in companies? I mean, that's actually a really important one. We've run the math and we figured that between pre-seed, maybe seed, and Series C of a company, you're probably going to get diluted down by like 66%.
Oh my! Yeah.
So if you own 10% of the company at seed, which is a lot to own at seed, you should expect to have 3% by Series C.
Mm-hmm.
So if anyone's telling you like, "Oh, we're going to capture 10% of a company at seed, and then it's going to be $1 billion company, and that's how we return our $25 million fund 4 times over," you got to figure out, okay, well, what's your follow-on strategy? Because your multiple is not going to be 10x on that. Your multiple is going to be like 2x, because you're going to need to follow on repeatedly in order to maintain that ownership. So realistically, you're actually going to own like 3% of that company if you bought 10%, and that 100 million might be significantly less if you don't have follow on, right? So be super aware of dilution as well. I think a lot of pre-seed and seed tends to select for people who are not very good at math, and you want to be able to make sure that they can actually figure out the dilution on the math.
Well, Zach, this is awesome. That was terrific advice, and I really, really appreciate all of that too. Thank you for your time today. Thank you for all you're doing at 1517, and for your continued efforts on Substack. I really appreciate that. I'm going to have to look for the next books in line.
Thanks, Matt.
All right, take care, Zach.
We hope you have enjoyed this episode of The Alternative Investor. If you found this valuable, please be sure to like, subscribe, and share. This show is brought to you by Honey Hive Capital Partners. Visit us at honeyhivepartners.com to continue your alternative investment journey. This recording represents the views and opinions of its guests and does not reflect the views and opinions of Honey Hive Capital Partners, LLC. Nothing in this recording, nor any communications from it, should be treated as constituting financial, investment, legal, tax, or other advice of any kind, or as a recommendation to buy or sell an interest with respect to any investment. We look forward to you joining us next time.